here to unpack the inflation data that we got this morning, also Fed policy, what this means for the Fed going forward. We want to bring in Ann Sonders. She's joining us on the phone. Charles Schwab, Chief Investment Strategist. Ann, it's great to speak with you again. Raphael Bostic saying everything is in play. Now there's talk of a 100 basis point hike at the end of the month. What do you think of that?
Well, it's not surprising. In fact, if you look at the futures market, it's signaling, 88 basis points. So that's getting close to a 50-50 split. And I think if the market continues to move toward pricing in 100, if you don't hear the Fed pushing back on that, then I would think it would be a done deal, because the Fed tends to move consistent with expectations, or in the case of last month, the hint they dropped to the Wall Street Journal.
So then, Liz, as we look at the reaction we saw from the markets today, obviously we saw it dive in early trading, but then obviously coming back to a relatively flat place. How much of this is priced in at the moment, and are they pricing this in correctly in terms of how they see the potential rate hikes going forward?
Well, I think what we may be seeing with some resilience here in the market, clearly preceded by a pretty brutal bear market. So I think a lot of the negative news is priced in. And what may be starting to come into the mix is a realization that recession is sooner, not later. And we've been in that camp. I think one has probably already started. And a more aggressive Fed. The combination of a more aggressive Fed and a recession sooner rather than later probably is the ingredient in the recipe, the key ingredient in the recipe to bringing inflation down, which is why now you see an inversion all the way down to the 6 month. And I think we now have the bond market telling you that they ultimately will be successful via the recession, via the squashing of demand, and that maybe solves the problem earlier than what would have been the case if this continued to push into 2023.
What suggests to you, Ann, that we are in a recession, and what do you expect GDP to come in at?
So I don't have any greater ability to forecast GDP than anybody else. We can all look at the Atlanta Fed GDP now. That's still down a little more than 1%. You had negative GDP print in the first quarter, which, by the way, 2 quarters in a row of negative GDP is not the definition of recession. So I don't cite that for that reason. But what happens with a recession once it's declared as official, the NBER, when they make the announcement that, okay, we're in one, which is often, way down the road, the process of dating when it started by month, they go to the peak in the aggregate data that they look at. And I don't think it's a stretch to say that the aggregate data they look at, which is payrolls, industrial production, business sales, and personal income, probably has already peaked, which means ultimately we may find out that as we're having this conversation here, it had already begun. If that's not the case, I still think it's sooner rather than later. And it's almost inevitable.
Yeah, and Liz, you mentioned payrolls there. Just unpack the jobs report that we got just last week, because lots of questions about whether or not we're going to need to see unemployment rise a little bit in order to see the economy cool. I guess my question to you is, how much cooling do we need to see when it comes to the labor market? Because when you take a look at the numbers, it's pretty tight right now.
Well, so here's the thing. You got to take labor market data and understand which are the leading, coincident, and lagging indicators. The unemployment rate is a highly lagging indicator. The average increase in the unemployment rate heading into a recession is only 0.3. It's not a heads-up indicator. It's the economy that goes into a recession that then causes the unemployment rate to go up. It's not the case that the unemployment rate starts to move up significantly and then you get a recession. Payrolls are a coincident indicator. In addition, when we get the jobs report, you get a household survey and a payroll survey. Mm-hmm. They can often differ, but the household survey tends to lead and be the more important message at potential inflection points. And 2 out of the last 3 months, the household survey was negative, to the tune of 315,000 with the most recent release. And then if you look at unemployment claims, which is a leading indicator, they're up 36% from the April low. And the average increase in unemployment claims heading into recessions is only 20%. And then you add to it things like layoff announcements using the Challenger data, now up 60% year over year. And then the anecdotes of hiring freezes, potential layoff announcements. I think it all just stacks up to not a message of we're in implosion mode here, but it probably gets worse from here, not better.
And Lizanne, is that going to be the case for the consumer as well? We've seen consumer spending and consumer sentiment fall, and obviously what we're seeing in terms of wage growth, certainly not keeping anywhere near the pace that we're seeing with inflation. Right. How much do you think the consumer is going to factor in what we continue to see in earnings and other economic indicators going forward?
Yeah, I think the consumer is already pulling back. You hear that from companies, especially now as we get into second quarter earnings season with demand faltering. You also have recession rhetoric that even if we don't know with any kind of certainty whether we're in one, just the sort of incessant chatter about it has a dampening effect. If you look at the more recent decent spending growth, the problem is that a lot of that was on the back of an increase in revolving credit. I think this excess savings story, which has been seen as a positive, that's an aggregate story, but that's biased up the income spectrum. And that cohort is now being hurt by the wealth impact of a bear market and some weakening in housing. So I think the consumer is paring back here, especially on the goods side of the economy, a tremendous amount of pent down demand. You still have decent services spending, but, unless we see a very quick reprieve in inflation, to your point, wage growth in real terms is in negative territory. Personal spending in real terms is in negative territory. Personal income in real terms is in negative territory. So I think there's no way the consumer doesn't pare back from here.
The only good news, though not reflected in this report, Lizanne, is, of course, gas prices have fallen significantly in recent weeks, and the White House is doing their best to champion that news as a hint that inflation may have peaked and begin to come down. Is that your sense of things?
Yeah, the problem is that on the energy side, we also have the Russia-Ukraine war. And as a factor in driving energy prices, you can't put that in any kind of economic model. Yes, I think the retreat we've seen in energy prices and broader commodity prices does suggest that maybe next month we finally start to see a peaking. But there was a lot of economists saying that we were likely to see that heading into today's report, and clearly that is not the case. So, yeah, I think it's likely that we may be at or near a peak, but we've got uncertainties, not least being tied to the war, that make it a kind of a trickier call.